Amundi S.A, the leading asset manager in Europe and a top 10 global player, presents a compelling investment case characterized by accelerated operational momentum, a clearly defined efficiency-driven strategic roadmap, and a significant valuation discount relative to European peers. The core of this analysis rests on the successful implementation of the new 2025-2028 strategic plan, Invest for the Future. A. Investment thesis summary and recommendation. The analysis concludes that Amundi is poised for a significant multiple re-rating driven by structural growth in high-potential segments, Asia, retirement, technology, coupled with aggressive operational efficiency targets. The stock's current valuation does not adequately reflect the certainty of the firm's earnings trajectory, particularly the committed cost savings and predictable shareholder returns. Accelerated growth in strategic pillars. Amundi has successfully accelerated growth in key areas, evidenced by the third-party distribution segment reaching its Ambitions 2025 plan target 1 year ahead of schedule. Further expansion is codified by ambitious net inflow targets in Asia greater than $150 billion and retirement greater than $100 billion by 2028. Operational efficiency as an earnings floor. The 2025-2028 plan prioritizes achieving an industry-leading cost-to-income ratio (CI) of below 56%. This structural commitment to cost control, powered by a proprietary AI platform and significant organic investment, provides an assured path to the 2028 minimum earnings per share target of more than €7. Compelling undervaluation. Amundi currently trades at a normalized price-earnings ratio (PE) of 9.37x and a price-book (PB) 1.09x, representing a material discount of approximately 27% to the implied European asset manager peer average PE greater than 12x. The commitment to a minimum 65% payout ratio further reinforces the investment floor. B. Primary risks and mitigation. The execution of the strategic plan is the primary source of operational risk. 1. Execution risk on strategic targets. The ambitious goals, such as capturing greater than $150 billion in Asian net inflows and doubling Amundi technology revenues by 2028, require flawless execution of the committed $800 million organic investment. Failure to deploy capital effectively could compromise growth targets. Mitigation. Operational momentum in the first 9 months of 2025, driven by strong inflows in Asia, third-party distribution, and ETFs, validates the initial strategic prioritization and provides a high degree of confidence in the firm's execution capabilities. 2. Geopolitical and competitive risk. Amundi operates in a highly competitive global environment, facing structural pressure from U.S. financial firms expanding their European market share. Regulatory divergence or political protectionism could impact cross-border growth. Mitigation. Amundi leverages its position as Europe's largest asset manager and actively aligns its product offering, for example, defense-focused ETF, with European strategic autonomy goals, providing a crucial differentiation and political support framework. Furthermore, management is actively advocating for regulatory simplification to enhance European competitiveness. I. Global scale and European dominance. Apasemi, the dominance European asset manager, ranking among the top 10 globally, provides a powerful structural advantage. As of September 30, 2025, the firm achieved a new record for assets under management, AUM, at $2,317 billion. This scale confers significant benefits, including superior operating leverage, pricing power in institutional mandates, and the ability to invest robustly in technology and international expansion. The firm's offerings span the full spectrum of investment strategies, including active, passive, ETF and index, and private assets. Within the highly competitive European ETF market, Amundi has historically demonstrated a growth rate ahead of the overall European ETF market, maintaining its position among the top providers. This product breadth ensures adaptability, allowing the firm to capture flows from institutional clients, distributors, and fund managers across multiple asset classes. B. The importance of Asian joint ventures. Asia represents a critical and proven high-growth engine for Amundi. In 2024, AUM in Asia increased by plus 17% year-on-year, reaching €469 billion, fueled by plus €28 billion in net inflows across the 9 countries where Amundi operates. A substantial portion of Amundi's earnings expansion is derived from its equity-accounted joint ventures in markets such as India, SBIMF, China, ABCCA, South Korea, NH Amundi, and Morocco, Wafa Gestion. This earnings stream exhibits disproportionately rapid growth, expanding by plus 20.9% in 2024, faster than the firm's overall gross operating income. The performance of SBIMF in India is particularly noteworthy, with its contribution exceeding €100 million, €104 million, for the first time in 2024, reflecting a plus 31.5% increase compared to the prior year. The rapid growth achieved by these JVs structurally enhances the quality of Amundi's overall earnings stream. Since these partnerships are capital light, they deliver high-margin earnings growth that is less correlated with European market cycles. This geographic diversification provides a crucial hedge against regional economic slowdowns, increasing the predictability and sustainability of the firm's overall earnings profile. Furthermore, the planned listing of the Indian JV, SBIFM, in early 2026 acts as a near-term catalyst designed to crystallize and unlock the embedded value of these high-growth capital-light assets for shareholders. A high degree of operating momentum was further confirmed by the 2024 annual results, which showed that overall net inflows reached plus €55.4 billion, doubling the 2023 inflows and marking the highest level since 2021. The success achieved in third-party distribution, which reached its 2025 growth target 1 year ahead of schedule, provides a significant operational advantage. This acceleration results in a higher assets under management base for calculating management fees under the 2025-2028 plan, which serves to de-risk the top-line growth component required to meet the 2028 earnings targets, even if future market appreciation is only moderate. C. Competitive headwinds and strategic response. Amundi's Deputy Chief Executive Officer, Nicholas Colquhoun, has openly acknowledged competitive pressures, particularly from U.S. financial firms aggressively expanding their market share across Europe. The strategic response is multifaceted. First, Amundi is leveraging its position as the largest European manager to align with European policy objectives, advocating for policies that promote strategic independence and sustainability. This commitment is demonstrated by its active participation in financing strategic sectors, including defense, through dedicated funds such as a new ETF focused on European defense. Second, management is actively pushing for regulatory simplification and updated public procurement rules that favor European companies, aiming to enhance the competitiveness of the continental financial services sector. By strategically positioning itself at the intersection of capital markets and European public policy, Amundi ensures its continued pivotal role in directing European savings toward the real economy. 3. Strategic Deep Dive. The Invest for the Future 2025-2028 Plan. The 2025-2028 strategic plan, Invest for the Future, is a disciplined blueprint prioritizing growth, diversification, innovation, efficiency, and selective investments. The plan aims to generate over €300 billion in cumulative net inflows across its strategic growth pillars by 2028, excluding the exceptional exit related to India's EPFO request for proposal. A. High Conviction Growth Pillars. Pillars 1, 2, 3. 1. Accelerate client diversification, retirement, and digital. The plan is highly focused on capturing demographic and technological shifts. In retirement solutions, Amundi targets generating more than €100 billion of net inflows by 2028. This strategy capitalizes on the global movement from defined benefit to defined contribution retirement plans and the growing distributor demand for bespoke, individualized solutions. A new dedicated business line has been established to expand market leadership beyond core markets, France, Italy, into Northern Europe and Asia, blending public and private strategies. In digital distribution, the firm aims to grow its digital client base by 50% by 2028. This involves supporting digital players as they migrate clients up the savings value chain toward wealth management, while also assisting traditional banks in digitizing their client offers. 2. Expand geographical reach, Asia and Northern Europe. Geographical expansion centers on penetrating high-growth regions. Asia remains the most critical external growth vector, with a target to capture more than €150 billion in Asian net inflows by 2028. This ambition is supported by the firm's established regional footprint, combining strong direct presence with successful joint ventures. In Europe, the strategy involves continuous growth in existing core markets while selectively capturing market share in Northern Europe, specifically the UK, Germany, Benelux, and the Nordics. 3. Drive innovation in solutions, active, passive, private assets. Innovation is essential for defending and expanding market share across product types, ETF and index management. To reinforce European leadership, Amundi plans to launch 100 new ETFs by 2028 and create a new dedicated business line for active and white-label ETFs. Private assets. The firm is strategically positioned to capture growth from increasing retail participation in private markets. This is achieved through enhanced synergies with Crédit Agricole, leveraging the recent integration of Alpha Associates, and the long-term strategic and equity partnership announced with market leader ICG. Active management. The strategy includes scaling up flagship funds, developing high-potential strategies, quantitative, bespoke, and innovative solutions, including those leveraging tokenization and digital assets. B. Operational leverage and technological edge, Pillars 4, 5. The commitment to structural efficiency and technology is the most powerful determinant of future margin expansion and earning stability. 1. Activate Technology Roadmap, Amundi Technology. Amundi Technology is transitioning from an internal cost center to a critical external revenue source. The plan explicitly targets doubling Amundi Technology revenues by 2028 using the €95 million pro forma baseline from FY 2024, which includes the Ixigo acquisition. This growth vector focuses on capturing significant wealth management technology market opportunities, supported by new offerings like Data as a Service and the firm's proprietary AI Studio. The shift toward recurring high-margin B2B software revenues is a key valuation driver as it diversifies the earnings stream and mitigates risk associated with AUM volatility. Crucially, the ambitious Asian inflow target, €150 billion, is highly dependent on the success of this technology roadmap. Capturing vast inflows across Asia, particularly through digital distribution and new partnerships, necessitates a scalable, robust, and geographically adaptable proprietary technology platform. The doubling of Amundi Technology revenues and the implementation of AI-driven processes are therefore necessary structural preconditions for achieving the large-scale AUM capture envisioned in Asia. 2. Optimize operating model, efficiency and AI. The structural goal is to maintain an industry-leading cost-to-income ratio below 56% over the period. This target is the primary operational lever underpinning the 2028 EPS goal. A core component of achieving this CI target is the disciplined application of artificial intelligence. Amundi plans to leverage its proprietary AI platform to optimize processes, create client value, and reduce external expenditure. Quantitative targets include rolling out 50 AI applications at scale by 2028 and converting 100% AI platform access into 80% regular staff users. This focused, quantifiable approach ensures that the large organic investment of €800 million directly translates into permanent operational efficiencies and cost reductions, minimizing the reliance on favorable market movements for earnings growth. Capital deployment and shareholder value creation, Pillar 6. The strategic plan details a highly disciplined approach to capital management designed to maximize both organic growth and shareholder returns. Amundi commits €800 million to organic growth initiatives over the plan horizon, representing a 30% increase compared to the prior period. This targeted investment is directed exclusively toward the priority growth areas, technology, Asia, retirement, passive, third-party distribution, and private assets. Regarding external growth, the firm maintains strict financial criteria for M&A. Opportunities must drive growth, possess manageable execution risk, and provide a minimum return on investment (ROI) of 10% within 3 years. For shareholders, Amundi has committed to a generous payout ratio of at least 65% for the period 2025-2028. Furthermore, any remaining excess capital not deployed in value-accretive M&A will be returned to shareholders via share buybacks. This clear and quantitative dividend commitment, coupled with the flexibility to execute buybacks, creates a reliable financial floor for the stock, enhancing the attractiveness of the high current dividend yield and stabilizing the share price, particularly during volatile market periods. 4. Financial performance and trajectory analysis. A. Robust AUM and inflow generation. Amundi has consistently demonstrated robust growth, successfully navigating market fluctuations to achieve successive record highs for AUM. AUM reached 2,317 billion euros as of September 30, 2025. Flow generation remains strong and high quality. Net inflows for the first 9 months of 2025 totaled plus 67 billion euros, including plus 15 billion euro in the third quarter alone. This momentum builds upon strong full-year 2024 inflows of plus 55.4 billion. The qualitative aspect of these flows is critical. Despite a significant exceptional exit in 2024, net inflows into medium-long-term assets were a high plus 34.0 billion. This concentration of flows in sticky, long-term assets generally commands higher average management fees and minimizes exposure to short-term market noise, thereby enhancing the predictability and sustainability of management fee revenues. The momentum drivers in Q3 25, Asia, third-party distribution, and ETFs collectively generated between plus 20 billion and plus 30 billion in inflows over the 9-month period. This affirms that the firm's strategic resource allocation is already yielding results in the identified high-growth segments. B. Profitability and margin expansion. Amundi is exhibiting strong operating leverage, a crucial precursor to achieving the CI target of below 56%. In the fourth quarter of 2024, adjusted net income grew by plus 20.5% year-on-year to 377 million euros, significantly outpacing the adjusted net revenue growth of plus 14.6%. This margin expansion was primarily driven by management and technology revenues. The firm's adjusted earnings per share, EPS, reached 6.75 euro in 2024. This provides the baseline for the 2028 target of more than 7 euro. Based on the 2024 EPS, the implied compound annual growth rate required to reach the minimum 7 euro target by 2028 is only approximately 3.5%. Considering the underlying operational momentum, e.g. Q4 2024 net income growth of 20.5%, and the structural cost savings guaranteed by the CI target, the 2028 EPS projection appears highly conservative. This conservatism suggests management possesses a high degree of confidence in the achievable cost efficiencies from AI and process simplification. The acceleration of income from equity-accounted joint ventures, which grew by 20.9% in 2024, also provides an important diversification effect. Since Asian markets often operate on cycles independent of Eurozone stability, this strong capital-light income stream offers a valuable decorrelation mechanism, further bolstering the overall quality and stability of Amundi's earnings profile. 5. Valuation and target price derivation.
A. Relative valuation analysis. Amundi's shares currently exhibit a material discount across standard valuation metrics when compared to major European asset management peers. This suggests that the market has yet to fully internalize the firm's strategic success and superior capital return policy. The data reveals that Amundi is trading at a discount of approximately 27% to the implied average peer PE multiple. The price-to-book ratio of 1.09x is particularly compelling, as it implies the market is pricing the firm barely above its reported book value. This fails to reflect the inherent high profitability of a capital-light asset management business model, which typically warrants a material PB premium. Furthermore, the low price-earnings-to-growth PEG ratio of 0.32 signals a significant disconnect between the firm's perceived growth potential and its current valuation. If Amundi achieves success only moderately above the conservative 3.5% EPS CAGR implied by the 2028 target floor, the PEG ratio suggests that rapid and substantial multiple re-rating is justified, as low PEG ratios traditionally indicate undervaluation relative to growth prospects. The reliable and high forward dividend yield of 6.32% further enhances the stock's attractiveness as an income investment. B. Forecasting and target price derivation 2028 projection. The valuation model utilizes a forward-looking PE approach based on the minimum stated financial target in the strategic plan. 1. Base case earnings projection. The anchor point is the management's committed minimum earnings per share target of €7 in 2028, achievable under constant market and forex scenarios. 2. Target multiple justification. Given Amundi's superior scale, strategic clarity, high earnings visibility derived from the cost efficiency target CI less than 56%, and commitment to returning excess capital, the firm warrants a higher multiple than its current depressed valuation. A justified target multiple of 12.0x is selected. This is structurally conservative as it remains below the implied peer average of 12.74x, accounting for execution risk while recognizing the strong operational fundamentals. 3. Target price calculation, PE method. Target price equals target PE multiple times 2028 target EPS. Target price equals 12.0x times €7 equals €84. With the current share price trading around €64.75, this derived target price of €84 implies an upside potential of approximately 29.7%. This contrasts sharply with the analyst consensus target price of €66. If the market were to price the stock at the consensus target using the 2028 EPS floor of €7, it would imply a normalized PE ratio of only 9.42x, €66, by €7, which is effectively the current depressed multiple, 9.37x. This disconnect suggests that the broader consensus has failed to price in the value inherent in the firm's efficiency gains and successful strategic execution, presenting a strong counter-consensus opportunity. C. Risk factors and sensitivity analysis. The realization of the €84 target price is highly sensitive to success in capturing flows in key strategic areas. A major failure to achieve the 150 billion Asian net inflows or the 100 billion retirement inflows would place significant pressure on top-line growth. In such a scenario, the firm would rely almost entirely on achieving the aggressive cost reduction targets to mitigate the impact of reduced management fees. Furthermore, asset managers remain sensitive to widespread and prolonged market corrections. While the strong operational efficiency targets provide a structural buffer, a severe correction, example 20% plus decline in global equity markets, would negatively impact the entire AUM base, requiring a rapid reevaluation of the 2028 EPS trajectory and associated valuation. V. Conclusion. A. Consolidated investment rationale. Amundi S.A. represents a fundamentally sound investment in the global asset management sector. The firm leverages its dominant European scale, 2.3 trillion AUM, and privileged relationship with Crédit Agricole to pursue high-growth, diversified opportunities in Asia, retirement solutions, and technology. The 2025-2028 Invest for the Future plan provides a comprehensive and quantitatively rigorous roadmap designed to deliver predictable earnings growth. The combined effect of structural inflow targets, greater than 300 billion cumulative, and disciplined cost management, C/I less than 56%, structurally de-risks the path toward the $7 plus EPS floor. The market currently assigns an unjustifiably low valuation multiple, 9.37x PE, to a business displaying these characteristics, presenting a clear opportunity for multiple expansion. B. Key catalysts for re-rating.
Several specific events are anticipated to force a market re-rating toward the justified target multiple. SBI FM listing, early 2026. The successful listing of the high-growth Indian JV, SBI FM, is expected to unlock embedded value, providing clear transparency and positive visibility into the long-term success of the crucial Asian growth strategy. Confirmation of efficiency gains. Quarterly financial reporting demonstrating tangible reductions in the C/I ratio, confirming the success of the AI-driven operational optimization and the rollout of the 50 planned AI applications by 2028. Capital return validation. The formal initiation of a share buyback program demonstrating management's adherence to the commitment to return excess capital when accretive M&A opportunities are not available. Amundi's blend of structural growth, operational resilience, and disciplined capital return dictates a significant reevaluation of its market price. The analysis indicates that the current valuation fails to reflect the predictable earnings trajectory set forth in the 2025-2028 plan.